Welcome back. I'm going to pick up where we left off and talk about option derivatives. We're going to focus mostly on options here. And there's a lot to go over, and it's a little bit complicated. Again, I'll give you my standard warning. We're going to talk about call options and put options. Right? A call option is an agreement that gives the investor the right, but not the obligation to buy a stock, commodity, or other instrument at a specified price during a specific time period. A call becomes more valuable as the price of the asset appreciates. You should remember that the call gives you the right to call in the asset. You profit when the underlying asset increases in value. So in a call option, let's say the price of a stock is currently $10. You buy the right to buy it at $15 next March. If the price of the stock is less than $15 in March, your call will expire and becomes worthless. And whatever money, whatever premium you paid for the call, you lose. But if the stock price is at or above $15, you now have the right to exercise and buy 100 shares at that $15 price. So if the stock is selling in the market at $16, you just made $100. You made $1 for every share you can buy. A put is the opposite. It's a contract that gives the owner the right, but not the obligation, to sell a specified amount of the underlying asset at a set price during a specific time. A put becomes valuable when the underlying price depreciates relative to the strike price. So the price in the option is called the strike price. So here's an example, and I got lost the last time I tried to go through this. If you have a March 2022 put options that gives you the right to buy ABC stock, 100 shares at $10, that's what this is. You have the right to sell. You have the right to sell, to put. You have a put right to sell. Between now and March of 2022, you can sell stock ABC at $10 a share for 100 shares. And that's great. So when you bought this, the stock was probably selling at, I don't know, maybe you were selling it to $11, $12, $15 a share. But now time goes by, and now the shares of ABC are now selling in the market for $5. So you can go to the market, you can buy it for $5. You've got the right to sell it for $10. So in theory, if you wanted to, you could buy 100 shares for $5 a share, and then you would have the right to turn around and sell those 100 shares that you bought for $5 each for $10 a share, right? Because you have a put that lets you sell it. So you could buy it for $5 and sell it for $10. Hence, you would make $500 on 100 shares, right? So that's what a put option does. A put option is betting that the stock goes down. The call option bets the stock's going up. Simplified application. Again, I'm going to say a lot of this repetitively here, right? You buy a call or a put with a strike price and an expiration date. That's always the case. Whether it's a call or put, it always has a strike price and an expiration date, right? The call. If the market price is above your strike price and you bought a call, the option will exercise automatically and you will get paid, right? Buying calls is a bet that the market goes up, right? So if you bought calls at a strike price of $10 and the stock at expiration date, at the expiration, the stock is selling for $11, you're going to get paid $1 a share. You make $100. Puts on the other side. If the market price is below your strike price and you bought a put, the option will also exercise, right? Buying puts, buying calls is a bet. No, buying, this should say puts. Buying puts, that's a typo, excuse me. Buying puts is a bet that the market goes down. So this is basically the same information about calls and puts. You know, if you buy a call, you pay a premium for it. You have the right to purchase shares at a particular stock and agreed upon price with an expiration date. The seller receives your premium and agrees to the obligation to sell you the shares. On the put, you buy a put, you pay a premium for a contract that gives you the right to sell the shares at a particular price. The person selling you the put receives the premium and agrees on an obligation to buy the shares at a particular price. That's the difference between the two. This slide is the same information as the seller's rights and obligations. So again, we'll be real simple. Calls, you buy calls, you're betting the market goes up. You're betting that the price of that stock goes up. Puts, you're betting the price of that stock goes down. Okay, you can buy a call. Here's an example, right? Caterpillar stock, symbol is CAT, the Class A stock, right? The expiration date was January 21st, 2012. Let's see this old slide. Okay, the strike price on the call was $35. If the market price was $63 as of January 21st, then you made money. You made $28 a share. Now, if the market goes down, let's say you bought the same option, same call, and you bought the same call on Caterpillar at the same date at a strike price of 35, but the market, it's only worth $32. Then you lose everything. So again, a call is a betting that the price on the market will be more than your strike price. If it's more than your strike price, you get paid. If the market price at expiration is less than your strike price, then you lose, you get nothing. On puts, it's the same thing. Also, you have to factor in any premium you put, which is a sunk cost. But on puts, you're betting the market goes down. So if you bought Caterpillar, you bought a put, and you bought Caterpillar with a strike price of 35, and the market is selling Caterpillar on January 21st at $32, you made $3 a share. You made $300 for each option. If the market goes up, you lose. And that's really it. It's the betting you're betting the market goes up or not. You also have to factor in as a sunk cost, the cost of the premium. Again, say it again. Call is a bet that the market goes up for that security. Put is a bet the market goes down. Now, there's certain naming conventions for stocks and for options. Basically, if the symbol is, let's say, KO, Coca-Cola, and the expiration date, the year, the month, the day, and C is for calls, P is for puts, and then the dollars and cents. So a call on Coca-Cola that expires on September 18th, 2010, for $52.50 would be, that call would have the naming convention KO1009118C00052500. Okay. So that's all I want you to do. I want you to understand that when you see these people who trade options see these quotes, and it looks like jibber jabber to someone who's not familiar with it. But when you're given the code, you understand how to read it. It's actually very easy to read, and makes a lot of sense. And again, if you go onto different sites, lots of different sites, this actually shows it calls on Apple. This is a few years old. This was Apple 2011, May 21st calls selling for $170. And that's what that was. And it was probably somebody, I don't know if somebody made money or not on that. But this is interesting because this shows you that the premium paid for this call was $176. So for $176, someone bought this option and they controlled the buying power on 100 shares of Apple at $170 a share. So it cost them $176 to buy the controlling of $17,000 worth of securities, which is a pretty good deal. All right. So that's the naming convention, and that's how you read this. And you'll see that there's all sorts of sites that list this, and you figure out whether they're in the money or not. Okay, and options are wasting asset. This means that the value declines. So as you get closer and closer to the expiration date, the value declines. Okay, an option can be either worthless, or the holder may exercise the option and recover some value prior to the date. The holder may sell the option. Right, so there is a secondary market for selling options. Again, this is a simple example of, let's say you have stock XYZ, it's trading at $20 a share. You think it's going to go up to $25 a share in the next 2 months. So you might buy a call at a strike price of $22 a share with an expiration date 2 months from now. The option worth 100 shares of the stock, but it costs you less than 100 shares to control that buying power on stock XYZ. There's a complicated formulas to determine this and how much it sells for. And it's really more for sophisticated investors. Now, let's say you imagine that 1 month from now, XYZ is trading at $25 a share, and you want to exercise your option. You have the right to buy 100 shares of XYZ at 22, even though it's currently trading at 25. And this gives you 2 choices. You can either immediately sell the shares for $3 a share and gain $300, or you can continue to hold the shares, in which case you have to buy and settle. You have to put the money, actually buy and settle, and hold those shares and take them into your portfolio. So what often happens is people don't actually buy the shares. They don't actually take possession of the shares. They don't settle the shares. What they do is they just exercise the option and take the difference. So I'm going to talk real simply here about buying an option through the Option Clearing Corporation. They provide the market. So you got somebody who is writing options, writing calls and puts, and you have buyers who are paying premiums. And the OCC matches these 2 up and handles they issue the option to the buyer and they pay the premiums to the sellers. And then later, if the options are in the money, what they do is the OCC handles the clearing of that. The actual OCC goes in and assigns it out to the person you bought it from is not necessarily the person it will exercise against. It gets assigned by somebody randomly by the OCC, who then handle the transaction and settle it, clear it. Now, the last point I want to make here has nothing to do with option derivatives, but people will talk about employee stock options. Someone will say they have stock options. Employee stock options are not option derivatives. They are not derivative products. They're completely different. They're part of the equity product family. If you remember, we did an earlier video on equities, and we talked about employee stock purchase plans, employee stock options. Employee stock options are not publicly traded options. They're not derivative products. So if you hear that term, it is not related to this topic. It doesn't go to the OCC. With that, I thank you. I know that was a lot to go through very quickly. Options are geared towards sophisticated, qualified investors and not for the faint of heart. If you have any questions, please contact me. I'll be happy to do my best to answer.